If you're massively confused by what's going on, you're in the same boat as everybody else, including myself. I always tell people, I don't understand banks, so I avoid investing in them. If I can't determine the value of a company, then I don't invest in it. And banks have a different way of looking at things that I think you've seen in the last week, that is pretty apparent. It is funny to me that suddenly now all these analysts are downgrading banks. There was a joke 2 weeks ago that if you look at the analyst recommendations on Silicon Valley Bank, not a single analyst covering them had them as a sell. So it says one of two things. The analysts don't understand, or just like we always say, take what they say with a grain of salt, because they're also trying to get business from the companies that they analyze. Now, if you're new to this channel, 75% of the people who watch this video are subscribers. So please subscribe and share this with 5 other people that you think would find value in this. We've had a lot of great videos in the last week responding to what's going on in the market. Now, the market is currently, let's see how it's doing in our software. NASDAQ's up a little bit, Dow and S&P are down. Guys, last night, the NASDAQ was up 2% pre-market. This morning, it got to minus 1%. It opened, it was minus 1 point some percent, and now it's in the positive. These are completely irrational markets, and you cannot look at me and tell me that the efficient market theory works. For those of you who don't know what that is, which is probably 99% of you, and that's okay, that's why you're here to learn. The efficient market theory says that essentially every stock is priced appropriately because it factors in all the information out there on that stock. How can you tell me that the market's efficient and massive companies are fluctuating 5, 6, 7%? Look at Silicon Valley Bank. 2 weeks ago, it was a $250 per share company. It is zero today. How is that efficient? How is it possible they knew all the information? Those write-downs were going to happen, whether you realized it or not 2 weeks ago. It was going to happen. We have the 3 biggest losers in the S&P right now are banks. KeyBank is down 33%, Comerica is down like 48%, and First Republic is down like 75%. Come on. How can you tell me anything there is efficient? And I don't know if they're undervalued or not. It's not like Google. If Google fell in half today, I would be selling everyone's soul to buy Google stock, right? Because I look at Google and think it's probably pretty close to value right now. So I look at this saying, okay, we have a financial collapse. We had a second bank, Signature Bank, last night went under, okay? Now, is this the start of something big? I have no idea. I don't understand the banking industry. However, what I will say is that based on this is a great learning lesson for people out there. This is great to sit there and say, if you don't understand something, don't invest in it. If you have no clue what's going on, don't invest in it. Find companies that you can understand. Find companies that sell goods and services and have a balance sheet that you can understand. That's why we're here. We are trying to teach that on this channel. We're also trying to focus on the emotional aspect of investing. Right now, investing in banks probably looks pretty scary. And even for me, a guy who can understand things, I'm not willing to dip my toe in yet, but it doesn't mean you shouldn't. If you can figure out a way to understand banks appropriately, then I would take a look at them. Or look at an ETF. There are banking ETFs out there. So instead of making a play on a specific bank, if you maybe want to, this is not telling you to do it, but if you think that banking has been hit pretty hard, find a banking ETF that you can go out there and buy and dollar cost average into as it goes lower. Is this another great financial crisis? I have no idea. The US government has come back and said, hey, listen, we're honoring all these depositors. And this is interesting. I read somewhere today that the average US bank account has $5,700 in it, and the FDIC insurance level is $250,000. But here's the thing. Since when did people who deposit money in a bank become an investor in that bank? That's where I sit there and say, should we really have an FDIC insurance limit? I don't know. This is something to be discussed. But what's the purpose of having this $250,000 protection if we're going to go back up companies that have well over that? Because it's going to mostly be companies. Now, you might sit there and say, oh, we shouldn't bail those people out. But is their job really to be an investor in a bank? No, they're depositing money in a bank for protection. To go out there and is it their job to really understand the financials of that bank? Guys, I don't even understand the financials of the bank. My money's sitting at Merrill Lynch and Bank of America. Now, granted, I put 95% of my cash into 90-day treasuries, which is a totally different thing than having the bank back it. And a lot of people say this is the reason for this recent run on the banks. So what happened was SVB was making money in the short run by investing in long-term bills. But when the Fed went there and jacked up interest rates, as I've said before, it decreased the value of those long-term bills, bonds. And when those values drop, there's perceived to be a problem. People say, hey, there might be a run on the bank, and that self-perpetuates itself into actually happening. Now, Signature Bank, highly active in the crypto world. And crypto's up a lot today because people are saying, see, we need a decentralized currency. Okay. I don't get that at all. Why does that justify this? Why does that do that? Now, I think the major issues that we have to address, the Fed has to address, and the US government has to address is, what are they backing with FDIC? It will cost more money to insure bank accounts to whatever amount of money is in them. It'll absolutely cost more money. And if you ask me, a guy who has a business with really much higher levels than $250,000 in those bank accounts, would I be willing to pay a fee every year to ensure that as I go higher? Absolutely. Now, obviously, it depends on the fee. If you tell me 2% of the account value, I'm going to say, no, pump the brakes. I'm not willing to do that. I'd rather just put my money in a short-term treasury of 90 days and I'll get the same result. But if you tell me, Paul, it'll cost you 0.1% or 0.2% a year to insure your money, absolutely, let's go do this. I'm willing to pay for extra protection. Now, somebody's messaging me probably saying, Paul, check this out. And look at it now. The Dow is up slightly, the Nasdaq's up 0.34, and the S&P is down 2.36. Again, the Nasdaq has had over a 1.5% swing since opening. Guys, how is that rational? We literally have three major banks that are down 30, 40, and 75%. We clearly have an issue, and we have stocks that are up. Let's see some ones that might be up also. Is Tesla up now? Because it was down 5% at one point. It's not up yet, but it's getting pretty close to it. This is incredible. I don't understand this. It reminds me a lot of Moneyball when the market was falling and the price of their bets were going up. And they call and say, what the hell is going on here? And Jake Gyllenhaal said, remember what I said to you? This is how you get screwed at some point. I have to determine the price of these. I get to determine the price of these investments going forward until and I'm paraphrasing completely. But that's what it feels like right now. I'm like, wait, how do we have literally the 16th largest bank in the country fail last week? Another big bank, a top 40 bank in Signature, failed yesterday. And we're like, oh, markets are up. Maybe. And I'm not trying to be a doomsdayer. There'll be a time when I look at you and say stocks are undervalued. I just wrote today in our community. Every morning in our community, I post the stock market to GDP ratio for that day. And today I wrote, guys, I can't wait for the day where I finally say we're undervalued. Because right now we're still 57, 58% overvalued based on history going back to 1929. That's just using data. Whether the interpretation of the data could be wrong, completely different. I'm just looking at the data going back to 1929. And I'm sure we can find data to make it seem like it's less overvalued than it is. But it's very hard to find data that says it's undervalued. The only people I find saying that are people out there who don't understand things. Now, I met a great guy this weekend. I was at a little a cafe with my fiance. We were sitting at a table. This 90-year-old gentleman next to me, I won't bring up why, but he started talking to me. We're talking, and I said, are you retired? He's like, yeah, I've been retired from Merrill Lynch. I was there for 25 years. I go, oh, wow. He goes, you need any stock advice? And I laughed and said, I'm okay. And my fiance said, no, Paul, talk to him. I said, no. But then he said to me, he goes, Paul, I will tell you something. Cycles are over. And I just went, and I literally looked at this man. I said, sir, cycles are not over. Cycles are not over. And a 90-year-old man, and I looked at that saying, this is his bias. He worked at Merrill Lynch, a retail investment firm. Of course, oh, this market's crazy. Cycle's over. We're going to be at a permanent high forever. Okay, sounds good. So don't look at age and think wisdom. And the guy was super nice, and I love him. He was a great guy, but he clearly had no idea what he's talking about. I tell people there are 3 guarantees in life: death, taxes, and cycles. Guys, subscribe to the channel, join the 75% of people who are watching this video who subscribe to us, and share this with 5 friends. I guarantee you will walk away smarter by watching 4 or 5 of our videos. Thank you very much for your time.